Just the first couple of two slides, fund performance, and thereafter we've got a little bit of an overview. So the funds used mostly by the IFAs and advisors out there is Ashburton Stable Income. Within its peer group there, which is your enhanced yield or your cash plus or your yield plus type of portfolios, money market plus portfolios, whatever the term maybe you prefer. We've had a very good run over the last 6 months. We've continued our good long-term track record. You can see over the last 6 months, for example, this fund did 2.72%. Annualized, that's about 5.6. And if you look at the money market funds, they did about 2 to 2.1%. So these funds generally giving about 60 to 70 basis points above your corporate money market type of portfolios. Just a reminder for those that aren't aware, the corporate money market funds and the Ashburton money market fund take no non-bank corporate exposures. In other words, it's just the big 5 South African banks, National Treasury and AAA rated international banks. But stable income gave you about 60 basis points above that, which annualizes to almost 1.5% per year. These funds are likely going to continue to outperform. We expect stable income to give 5.3 to 5.6% over the next 12 months, with interest rates potentially rising and some nice credit included in the portfolio. The other 2 portfolios that I know is used out there as well, a little bit in the bond fund side as well as in the diversified income. Ashburton Diversified Income is going to have a 3-year track record pretty soon. 12th of March, we'll start distributing 3-year numbers. We are very happy with the way we've recovered since June, since the end of March. Portfolios gave a great recovery after the March drawdown, so we are happy that we managed to stand up and more than make the losses back. And same thing true on the bond fund. Both of these portfolios have had a very good second half of the year and a very good January as well. Okay, that's the last fund information. Let's move to some budget numbers and some budget discussions. So firstly, and I think it's important to note, is that while the budget was broadly termed to be good, it was also broadly in line with expectations. A lot of the things that came out in yesterday's budget was signaled by Treasury and SARS the last couple of months. We knew that there would be an over recovery in tax, corporate tax, specifically as a result of resource companies. We knew, for example, that the government raised more money in loans than they had to over 2020. And we knew that both the GDP numbers from 2020 weren't as bad as people thought. And that all combined into the budget that we saw here. So the first thing is that those things combined, along with the projected spending cuts, now has debt to GDP peaking at just a touch below 90% in the 25-26 budget year. We're currently in the 21-22 budget year, so it's 5 years from now. They expect debt to GDP to be up at just a touch under 90%. The growth forecast for this year comes in at 3.3%. It is slightly higher than our Ashburton internal growth forecast, and 2022 is currently at 2.2%. We think that both of those numbers have potential downside to them. And it's going to take us a couple of years before we are back at the pre-2020 levels. South Africa has not managed to bounce back as strongly as many other countries globally. And we are aware of the fiscal and structural issues that contribute to why that happens. The one thing that was somewhat surprising, there was broad discussions about potentially new taxes. There were articles in the newspaper, comments and opinions on potential wealth taxes, etc. None of those materialized, which is very positive. And at the same time, we saw for the first time in years allowing for bracket creep, with inflation. We saw an increase in the brackets for personal income tax inflation. So everyone pays a little bit less tax on their the lower invested amounts and only start paying the top tax rates at higher numbers. So the next paycheck that comes in should be a little bit bigger than the previous one. That was, however, fully offset with increased taxes, specifically sin taxes and fuel levies. Sin taxes, as we know, alcohol and cigarettes. So it was revenue neutral from that perspective. The big concern in the budget still remains the fears and the issues around wages. South Africa pays a significant portion of its annual revenue, and the SA government, out as wages to public servants. Combined between wages and interest expense, which is also climbing, a very small amount of money is actually left for government to fund all of the other expenses that it might have. So if you think about it in those terms, one of the reasons that government's increasingly embracing private-public partnerships is because they no longer have the balance sheet space available to fund and construct many of those projects on their own. This, however, at least in my opinion, is probably a net positive, as we've seen those public-private partnerships, specifically in the first couple of rounds of the renewable energy programs, be wildly successful. The take-up of power was good. The management of it was good. The amount of corruption and other issues was negligible, concerned with some of the other things that we've seen. And they came in mostly on time and budget, compared with some of the more recent power projects by state, like Medupi and Kusile, that are still giving their own issues. But wages remains a big issue. We see that Kusatu was not quite happy with the budget. We know that there's unhappiness about the wage freeze, and they are still targeting 230 billion rands worth of savings. And then lastly, SOEs weren't given a lot of a mention. There was a mention of a 7 billion rand support to Land Bank, but no mention of the other big ones, Eskom, SAA, Transnet. And we know that not just reforming them, but taking them and reducing the cost that they have on the average South African is going to be key in ensuring that South Africa has a fiscally sustainable path and a growth path over the medium term. So let's just look at a couple of numbers in more detail. Fiscal deficits. We can see how all of these numbers vary. They're expecting a 9% fiscal deficit, and then that drops slowly over time. The interesting line I mentioned a little bit earlier is the line at the bottom. It's the debt service cost to revenue. And we can see the numbers are all slightly lower than that was thought at the MTBPS, the medium-term budget policy statement. But we still have 22% of our revenue being paid on debt service costs by 23-24. So that is a significant chunk of our money going out on expenses. If you look at, let's call it the elephant in the room, that's this number. It's SA's debt to GDP. And we can see that the last debt to GDP print came in at 80%. Now, this is vitally important, given that we know in 2016, 2017, just after Nenegate, we saw a debt to GDP number of 50%. So on relative terms, we saw our debt to GDP effectively rise by 80%. Right now, that's a significant number, moving from 50% to 80%, 50% to 80% to 90% is 80% increase. So those are significant numbers that we're going to have to deal with and come to grips with, because it makes us one of the most indebted emerging markets in the world, and it reflects on why our real yields are still so high compared to our peers. We have a question that was, what is the AUM of stable income and who supports the fund? The AUM of stable income is just under 16 billion rand. It is supported very widely by a range of clients. It's got the support base within the IFA space. It's got a support base within FirstRand corporate and RMB corporate and FMB corporate. It's got support base in the pension fund and the multi-manager space as well. For a fund to reach a 16 billion rand number, it has to have pretty wide support within the industry. It's got rating got reaffirmed as AA minus recently. So yeah, I hope that answers the question. So this debt to GDP numbers, it's important to realize that we're on a trajectory that gets us a little bit below 90% debt to GDP. And this is the first one of a couple of flags that I want everyone to remember, right? A couple of flags or sticks in the ground or the earth, or whatever, however you prefer to talk about your scenario planning. Let's start off with, this is the first one. Debt to GDP has been rising, is high, and is likely to continue to rise for the foreseeable future. So let's just quickly look at the bracket creep. These numbers are just, I added them here more for use than for anything specific. We can see the bracket creep numbers are better, and there's also the rebates on people over the age of 65, under 65 and 75 and older has changed. So just from a planning perspective, that'll help as well. The second thing I wanted to note is the inflation number. The last inflation number of 2020 came in at 3.1%. The first inflation number of 2021 for January came in at 3.2%. And we expect that inflation is likely going to rise consistently throughout the year. We also expect that inflation is going to see a spike in around April and May. So for those of you that have to do wage negotiations or clients that have to do wage negotiations, I'd recommend doing them before the inflation spike of April and May. And then towards the second part of the year, we expect inflation to come back down again, but it's not going to come back down to the levels that we've become used to from the middle of last year. So we expect that inflation is likely going to trend close to 4% for the remainder or the second half of 2021, which means that effectively from the middle of the year towards the end of the year, the SARB will sit in a scenario where you have negative real repo rates. So effectively, the SARB at the moment is in a position where the repo rates are positive. However, from June, it's likely that repo rates are going to be negative. And because the SARB is relatively conservative, they do not like and would prefer not to be in such a position, firstly. But they've also said that they are hesitant to increase interest rates until the economic recovery has gotten underway. So you've got these two competing forces against each other that is potentially or somewhat offsetting, but we feel that there's a likelihood of seeing rate hikes towards the end of this year, maybe the start of next year. There's a question here: is how will increase in inflation affect inflation-linked bonds? That's a good question because it affects it in the normal way that you would expect, in that higher inflation-linked bond, higher inflation rates lead to a higher returns on inflation-linked bonds, right? That's the traditional way that you think about it, and that's completely correct, because what happens with an inflation-linked bond is that the capital of the inflation-linked bond rises with lagged inflation every month, right? So effectively, your amount outstanding keeps on growing, and because your coupon is based on your nominal, the amount outstanding, your coupon keeps growing. So higher inflation leads to higher returns on inflation-linked bonds, right? That's the one thing. There's a secondary effect on inflation-linked bonds, which is also important. And that is that within the fixed income space, the only instrument that has a defined protection against inflation surprises and inflation upside risk is inflation-linked bonds. Which means that as inflation fears become more prevalent, and people start seeing more and more inflation risk, and inflation starts going higher and higher and higher, people are willing to pay more for that inherent inflation protection. So it makes inflation-linked bonds more popular, more demand, and that further drives down the yield. So over the last couple of years, with inflation being falling and relatively low, there's not been a lot of demand for inflation linkers. And this kind of peaked towards the middle of last year. If you ignore the blowouts that we saw in March, towards the middle of last year, some of our inflation-linked bonds were offering long-term 30-year inflation profiles of inflation +4 to inflation +5%, which was very, very attractive at that time. And we started buying some inflation linkers in some of the portfolios then. But as inflation starts becoming more and more of a risk, we expect that the yield, the real yield on inflation linkers will rally, which will lead to a secondary benefit to inflation-linked bonds. So there's a principal or a primary benefit to inflation-linked bonds with higher inflation, but there's also a secondary additional demand element that's also likely to help inflation-linked bonds going forward. There's another question here saying, Diversified Income Fund is coming up for its 3 years anniversary. Yes, 12th of March, the Diversified Income has been running for 3 years. With the exception of a drawdown that was larger than I would have liked in March, I am very happy with the fund's performance. The first 2 years of the fund performance was very good. March was a little bit difficult last year. Our drawdown was a little bit larger than I would have liked. But since then, we've recovered very well. From the end of March to the end of January, over that 10-month period, the fund did almost 13%. We're hoping that by the end of this year, March, when we've got 1 year numbers from March to March, that the fund performance will be anywhere between 13.5% and 14% for that period, which we're very comfortable and very happy with for a 12-month return on an income space. I remember having a discussion with the client at the end of March last year, and they asked, what could we get from this fund over the next 12 months? And I remember saying somewhere between 10 to 12%. And the client stayed in for that period. So we're happy to be able to have delivered what we promised at that point. Going forward, the yield environment's not as comfortable now as we were then, which is a disadvantage in that we expect different outcomes, and I'll come to how we build them later. But we expect that the Diversified Income Fund will give between 7 to 8% over the next 12 months, hopefully with potential upside surprises. But we think that's generally the range where the fund can, that the fund can do over the next 12-month period. Okay, so the first flag was higher debt to GDP. The second flag was higher inflation, and I've discussed this already. The third flag is potentially higher rates in South Africa. We can see if you take the FRA curve and the swap curve and you bootstrap that out to 5 years, this is the interest rate expectations for JIBAR going out 5 years. Now, I don't think anyone seriously considers that interest rates are going to be hiked 4% in the next 5 years, but the entire curve is upward sloping, pricing in only rate hikes, at least for the foreseeable future, no rate cuts. So interest rates, the front end of the curve is also more likely on its way up rather than down. The next one is this number. Now, we quite often talk about in this business about discounted cash flows and risk-free rates, etc. And quite often people forget that the risk-free rate most broadly used is the US 10-year. On the screen here, you can see the current US 10-year rate is at 1.45%. For most of the year last year, it sat between 0.5 and 1, and the narrow range was between 0.6 and 0.8. Rates in the US have effectively doubled from the average of 0.75 to an average of close to to a number of 1.5 now. A lot of this US rate increase is on the back of increased inflation expectations. If we look at where the US TIPS trades, US TIPS stands for Treasury Inflation Protected Securities. If we see where TIPS are trading at about -1%, then we can say, well, that the inflation expectation in the US is currently north of 2.5%. So there's certainly increased if not fear, but at least awareness that inflation in the US is on its way up. And this could also further push our inflation numbers up as well if global inflation rises. This is, however, not a done deal. There were significant arguments back in 2010 and 2011 about how the dump in money supply, significant increase then in monetary supply post the global recession then in 2008 and 9 would lead to inflation down the line, and it hasn't. In fact, up until relatively recently, at least, we've been in a 40-year cycle where interest rates and inflation consistently trended downwards for 40 years, since the late 1970s in the US, which was the last major inflation spike. So there's two very strong arguments on this side. One is pro-inflationary, other one's against inflationary. You could probably give a 3-hour seminar just on the prospects for global inflation. Some of the best talks that I've heard by this is there's a podcast by a guy called Grant Williams. He has a podcast. If you have a podcast player, just search for him. He does a podcast series called The End Game, and he has a lot of people talking about this. And a lot of them discuss growth and inflation in the US and go both ways. So this is the third flag in the floor: rising US rates and rising inflation offshore. We can also just quickly look at some other general things. We can see on the screen here, we have the VIX. The VIX is the US volatility index, and we can see that that is still trading above 20. Normalized levels is much closer to 15. So there are two things that's keeping this number elevated. The first one is there is still significant risk and uncertainty around everything from economic policy under Biden, tax policies, the rate of recovery, the vaccination rates, third wave, fourth wave, COVID issues, etc. And that's keeping volatilities higher. But there's another factor. For those on the call last month will remember I spoke about GameStop. GameStop was an example of a broader trend. There's a significant number of retail investors playing in a small and micro cap stock space and pushing prices around, and a lot of them get their exposures via options. And some of the large investment banks have been a little bit hurt on the option books on some of these shares, and they've reacted by making volatility a little bit more expensive to try and decrease the demand for options going forward and to make that business a little bit more lucrative. So both of those factors, I think, are playing into the elevated VIX numbers. Another one here is the JP Morgan EMBI, JP Morgan Emerging Market Bond Index spread. And what we can see here is that this is trading slightly below its 15-year average. It's rallied nicely since the highs last year, which were just in and around 600. We're currently trading at about 320. And the 15-year average is about 345. And the lows that we've seen in the last decade is about 240. So the trading and the valuation on this is it's no longer massively attractive, but it's not overly expensive or unattractive either. And when you tend to value assets, there are three things that you tend to look for. The first one is historical valuation on a relative basis, relative to its own history. In other words, a great example of that is the price-earnings ratio, and where the price-earnings ratio is trading relative to its own price-earnings ratio. That is an internal or a self or an historical valuation metric. A second one is a relative valuation metric. You look at the valuation of an instrument or an asset class relative to others. If you want to look at the PE ratios again, what's the PE of PE ratio of FirstRand versus Standard Bank versus ABSA versus Nedbank, right? Or in this case, what is the yield of one instrument versus another? What's the yield on inflation linkers versus nominal bonds, right? So it's a relative valuation. And then the third one is less concrete, but it's quite often a combination of quantitative valuation metrics and qualitative overlays, is what can an asset return over the next 12 to 36 months. And by using those three metrics, you generally have a good idea of the attractiveness of the asset classes in your portfolio relative to each other and where you'd be overweight and underweight. So the valuation of this EMBI, slightly below historic averages, is another just a flag for people to remember. So what has been driving emerging market revaluation that we saw on the previous slide? On here, the green bars above the line is bond flows, emerging market bond flows. And this chart was updated not to last week, to the week before last week. And to the week before last week, since July, effectively 7 and a bit months, we had 7 months of uninterrupted positive flows into emerging market fixed income assets. And that drove the markets for that period. Last week, by the way, was the first week emerging market bonds and emerging market fixed income has seen some outflows. If you look at what that looks like on a cumulative basis, the green line is emerging market hard currency debt. So it's effectively saying what, looking at South African debt, Brazilian debt, Mexican debt, Argentinian debt in dollars or in euros, in hard currency. The purple line is the same countries, but in their local currencies. And we can see, if you look at the hard currency bonds, it is trading above its cumulative all-time highs. If you look at the blue line, which is the combination of that and hard currency, it's trading above its cumulative all-time highs. And the local currency is trading effectively flat for the entire period. And we can see a couple of things from this chart. Firstly, investors have now, as always, preferred hard currency over local currency, and local currencies lagged hard currency a little bit. It's important to note because hard currency is a lot easier to trade. If you're sitting in New York, buying a dollar bond in Europe is a dollar South African bond in Europe is a lot easier than buying a rand South African bond in Joburg. To do the second one, you need custody, you need to do a currency exchange, you need to potentially hedge the currency risk, whereas you're already set up to buy your dollar bonds. And we can see from this that the wall of money that sat on the outside of emerging markets in the middle of last year has now mostly been neutralized. Most of that money's flowed already. We can't rely on an outside or an inactive investor that hasn't been investing in emerging markets to suddenly start investing. Yes, for a variety of reasons, we still think that emerging market assets look attractive, but there's no longer this catalyst or this impetus for a massive emerging market rally as there was 6 months ago. So let's look a bit at just South Africa and the situation here. And the first thing I just want to note is I've got two instruments on the screen, an orange line in the top chart and a white line in the top chart. And then at the bottom, you've got just the difference between the two, one minus the other. The orange line is 9-month bank NCDs, FirstRand, Nedbank, Absa, Investec, Standard Bank. They're 9-month bank NCDs. And the white line is 9-month government T-bills. And what we can see is over the last 5 years, occasionally, quite often around the end of the year, November, December, government T-bills would yield more than bank NCDs. But it would generally pull back. However, effectively since May last year, government T-bills are now yielding consistently between 20 to almost 60 points more than bank NCDs. Now, there's a variety of reasons for this. One, banks don't need as much funding because they're not giving out as many loans. So their demand for funding is lower. So they're raising less money. Government needs more funding, so they're raising more money. And the third factor is that government has become riskier. So this is interesting but it's still a shortish term instrument in a somewhat niche market. There's not a lot of secondary trade in 9-month NCDs. So let's look at something else. Here we have FirstRand's bond that matures on 21 Feb 2031, and the government bond that matures 28 Feb 2031. And what we can see in the 3 years post Nenegate, 2016, 2017, 2018. Now, this was a time when there was already concerns about South Africa and South Africa's structural issues. We saw the firing and departure of 2 finance ministers. We saw several other issues, elective conferences, etc. It all caused problems or potential problems, or raised the risk on the South African sovereign. Throughout that period, we saw that FirstRand debt was trading on average about 1.35% above the government bond that has the same maturity date to 7 days difference. Since then, however, it's been trending the other way. And since the middle of last year, the gap is consistently negative 50 points. So institutional investors like myself and others in the industry are paying up 0.5% in order to hold FirstRand debt rather than government debt. Now, that is an important metric. It means that there is a significant chunk of the South African investor base that is more comfortable with FirstRand exposure rather than SA government exposure. Or to put it another way, if yields reflect risk, then SA government is now seen as riskier than FirstRand. And the same thing is true with not just us and the FirstRand Bank, but in several Standard Bank and some of the other banks as well. It is just something to consider on the relative riskiness. Now that has like so many of these things, it has a positive element to it as well, and that is that you are at least being rewarded for taking the South African sovereign risk that you are. Let's look at that in another way. If you look at South Africa's real yield compared to many of our peers, you'll see our real yield is about 5.7 in our 10-year space, compared to Brazil at 3%, China at 3%, Indonesia at 4.6, Colombia at 3.9, Mexico at 2.4, Ukraine at 1.1, India at 1.1. So our real yield is significantly higher than many of our peers. And that's one of the areas where our higher debt to GDP ratios play out. So I spoke earlier about the attractiveness of emerging market assets, and I showed the JP Morgan EMBI. Let's look at another interesting metric. If we look at high yield debt in Europe and the US, and you look at where that's trading relative for the last decade, what you'll see is that for Europe, the top chart, high yield debt is trading effectively very, very close to its all-time lows. In fact, only for a short period at the end of 2017 did high yield debt in Europe trade at lower levels. And if you look at the US, the high yield debt has never traded like this in the last decade. In fact, the previous low was 5%. We're now trading just above 4%. So we know why this happens, right? And why this happened. It's central bank interference in markets. The central bank buys government bonds. It forces more people into credit. Central banks buy more investment grade credit, forces more people into high yield credit, etc. Right? And to put that in perspective, last year, 2020, the ECB bought 100% of issuance of the Northern European countries, and 85% of issuance, bought 85% of issuance for the Northern European countries and 100% of issuance for the Southern European countries. So if you are not buying government debt, and I wouldn't be buying government debt at negative yields either, you have to start buying other things. So we've seen what happens, and that is that clients and investors creep up the risk curve. Government bond buyers creep up to more riskier countries, or they creep up to investment grade credit. That drags investment grade credit down, so investment grade creditors creep up to high yield, and high yields creep up to emerging market debt. And it's important to realize that when we look at this chart is that we have to just think about central bank behavior. Central banks, if I think back to when I started in this industry and when I started studying and learning the theory, there were things that central banks just would never do and things that could never happen. Negative interest rates were impossible. They could never happen until they did. The US, ECB, BOJ monetizing and buying their debt could never happen until it suddenly did. But don't worry, they would never buy corporate credit until they suddenly did. But they would never buy high yield credit. Recently, 6-9 months ago, the Fed started buying high yield credit, and the Bank of Japan is the largest holder of ETFs in the Japanese equity market. There has been almost nothing that should have been, or that everyone believed to be sacrosanct within central bank behavior that has actually turned out to be the case. So whenever anyone says something cannot happen because the central bank cannot do it, I generally try and just keep an open mind, because thus far there has been no line the central banks have not been willing to cross in the interests of capital market and monetary stability. So there's a question here: will we buy the R213 at a current yield of 9.4? Okay, good question. Let's answer it quickly. So the R213 is South Africa's current 10-year bond. And I'll answer it this way. We just got 3 new mandates, and I bought 5 different bonds for all of them, and one of the bonds I bought was the R213. And there's a specific reason why we prefer bonds at that area of the yield curve. So if you will give me a second to explain a little bit further on, I'll explain why we are buying R213s and bonds, even though I've been sounding like an uber bear thus far. Okay, so let's quickly look at credit market issuance. If we look at 2020, credit market issuance dropped from 196 billion the previous year to 92 billion last year, and it's currently expected to do 93 billion this year. This happened at the same time when in 2020, fixed income and money market funds raised about, I think, 130 billion or more of increases in AUM. So you have a smaller, less diverse credit market and an increased asset base chasing it. That doesn't necessarily lead to great credit returns if you're only allowed to participate in the listed credit market. It's one of the reasons why we think that our ability to partake in the unlisted credit market and our partnership with RMB provides us with a significant moat in this space, because it gives us access to more credit at better spreads with potentially covenants and better insight into the companies. Whereas many of our peers are unfortunately forced into chasing less and less credit with bigger and bigger balance sheets. So this is where we try and bring together our various views, our various macro views on a bond valuation number. So there's a couple of things that impact things that we think are the most important and impact South Africa's bond yields. The first thing is the US 10-year, right? It's the base rate, and it impacts relative rates globally. If you can get, for argument's sake, 7% on the US 10-year, I promise you SA's 10-year is not going to be sitting at 9. So the higher the US 10-year rate goes, the higher the SA 10-year rate goes. It has a pretty decent correlation and a pretty decent feed through. The second one is we expect inflation and interest rates to be, it's not going to be racing up, but it's going to provide upward pressure on our local bond rates. Inflation is going to rise by about 1% throughout this year. And interest rates, we're going to have to see how much and when we start pricing in interest rate hikes. But we could potentially see at least one interest rate hike maybe by the end of the year. For the moment, we don't have rates priced, rate hikes priced into our house view, but it's, at least personally, I think it's more likely that we see further rate hikes rather than rate cuts towards the end of this year. The next one is the debt to GDP number. That certainly has a big impact on our numbers. With our debt to GDP both being a lot higher than it was historically and continuing to grow, that will also provide upward pressure on our local bond rates. And the last variable in there is the EMBI, which is a proxy for emerging market bond valuation and emerging market attractiveness. And as I showed you, that's a little bit below averages, 15-year averages. So that doesn't have any real bias towards one way or the other. However, we think that the EMBI is likely going to continue to slowly grind down over the next couple of months, just as other rates, as US high yield and those rates remain low. However, if US rates continue to rise, we may have seen the end of significant rallies in EM, because if the higher US rates also become, the more they start becoming a competitor to your own rates. So we think bonds are where they're sitting now. To answer the question, bonds are roughly fair valued, but we're pricing in between 25 to 50 basis points in curve moves over the next 12 months. In other words, upwards pressure on the entire curve. And now this is where it becomes important to note that I don't mean that the yield on the 213, which is currently around about 9.4, is going to go to 9.9, right? When I say 50 basis points up moves, I do not mean 50 basis points higher yield on the bond. I mean 50 basis points higher yield on the curve, and there is a difference, and I'll show you what that difference is soon. So on this chart, I'll try to explain the difference between the two. So the bond, and this unfortunately chart is a couple of days old, so it has the 213 yielding 9.2 rather than 9.4. But the 213 is our 10-year bond. It's yielding 9.2. The 2030 is a 9-year bond, and it's yielding 8.75. If the yield curve remains unchanged, if we could potentially lock the curve in place, then over a 1-year period, we would expect the 10-year bond, which is now the 9-year bond, to trade where the 9-year bond is now trading. In other words, we expect that number for the R213, that yield, to go from 9.2 to 8.75. That concept is called roll down or slide. Think about you've got an upward sloping yield curve. You have your bond sliding down the yield curve, and as a result, your yield is low, and that leads to capital gain. And we can calculate that, what the expected number is, because we know what the yield curve looks like. And that 1-year roll down, or that 1-year slide, is about 33 points, right? So if the yield curve remains unchanged, we expect the the R213 to be at 8.75 a year from now, right? Now, it's important here to add something else, that gives me my total return column, assuming no change. Now I have a position where I say, okay, but if the entire yield curve shifts up 50 basis points, that means I have to add 50 basis points to my exit yield, and that's where my second scenario comes from. What return do I get if yields move up 50 basis points? And depending where you're on the curve, if you ignore the bond right at the front, you get between 6% and 8% approximately. Where we prefer our bonds between the R186, so the 5-year bond, and the 2035s, we expect that bonds will give you between 7% and 8%. Now, here it is why we still like bonds relative to cash. Because our cash product, not money market, the other cash product that has some credit and some term, gives you about 5.3 to 5.6% over the next 12 months, while bonds in this space of the curve gives you between 7 to 8%. So to answer the question, yes, we do buy bonds at the current level because we expect them to still give you above cash returns over the next 12 months, even though a lot of the returns are priced out. So we think the R213 could give you about 8 to 8.5% over the next 12 months. At a recent meeting, however, one of the decisions we made was to move our bond allocation to neutral and our inflation-linked bond allocation to overweight. And the primary reason for that was this. If we use a similar metric as we did on the nominal bonds for inflation-linked bonds, where we take inflation at 3%, we take an initial yield, and we calculate an exit yield with roll down, we get between 8 to 9% on bonds. And if we add inflation at 4% rather than 3%, we get to 8.5 and 9.5% on linkers. So at the moment, our biggest overweight asset class is inflation-linked bonds, but there as well, we prefer the space up to the I-2029, so the shorter-term ones rather than the longer-term ones for most of our mandates. And in this space, I just want to add one thing. When I say our mandates, I'm involved and I run the portfolios, and my team, myself and my team, my colleagues run the portfolios that start with the money market fund all the way through to, we've just taken over 2.5 months ago, well, end of February will be 3 months. From 1st December, we took over the management of the multi-asset low equity fund as well. So this front end of your risk spectrum, that let's call it the first third of your risk spectrum, is where we tend to manage money. And it has a significantly more of a conservative focus and a focus on volatility and risk. So hence we like the less volatile, more front-end bonds. So this is my last chart before I move to final questions. And it's a chart for those of you that sat in multiple presentations will by now start to recognize. It is the gap between our risk asset classes and cash. That turquoise line is where you see the 1-year cash rate, your 1-year NCD. The dark blue line is your real yield on your 2033 linkers, which means if you add 4% to that, you get 8.3% yield. You've got 9% on your 10-year, and then you've got growth points having a forward dividend estimate of 12% in preference shares. Those are all of them. The bank preference shares are yielding about 9% as well. So we are still in a situation where we have historically massive gaps between what cash can give you and what your risk assets can give you. Now, do not make a mistake, right? The reason SA bonds are giving you what's effectively a CPI plus 5% return is because SA bonds are now a lot riskier than they were a decade and a half ago, right? So I'm not necessarily advocating just moving all of your cash to bonds, but having fixed income, and especially these fixed income asset classes, play a larger role in your portfolio is important. If we take our estimate on inflation over the next 12 months at 4%, that means that the real yield on your linkers, we can see there's 4% real yield on linkers, 5% real yield on your 10-year, 5%, 6 or 7% real yield on property, and about a 4-5% real yield on preference shares. This is compared to a historic real yield of 6% on equities. So the point I'm trying to make is that it's, in my opinion, increasingly likely that fixed income will play a larger role in people's asset allocations over time, as many of the local asset classes have become more risky. We're increasingly seeing in flow terms as well that investors are preferencing SA fixed income and offshore risk to try and get that best of both worlds, because offshore fixed income is, well, and except for a couple of places and maybe a risk hedge, looks very expensive. So that combination of taking SA fixed income with the increased offshore equity allocation, rather, as a portfolio composition strategy. This is our current asset allocation. It's rough and broad, but we're neutral bonds with a preference for that 7 to 12 year section. Probably because of the difficulties there, accurately, I would say from the R186 now to the R2035s. We like linkers specifically at the front end. We still underweight money market assets, not because we've got an issue with credit. We think that there's value in the credit spreads in a lot of cases. We've picked up very nice, high quality paper at very decent yields, very decent spreads at least. The problem is that JIBAR is still very low. So JIBAR is still at 3.6%, which means your base rate is low. The moment that starts adjusting upward, credit will start playing a larger role again in portfolios. And there's also a lot of other things that you can do in portfolios where you, for example, in our bond portfolio, we buy credit and we do what's called a portable alpha swap or portable alpha technique to transport the credit spread onto a bond base yield, which gives us effectively bonds plus credit, which have helped as well. Neutral preference shares, underweight offshore bonds, and then slightly underweight local property as well. If there are any other questions, we've got 5 minutes, and I'll stay on a little bit longer. Thank you very much for everyone that joined. Let's see if there's a question or three we can get through. Okay, it seems there were no more questions. I hope this was informative. If you have any feedback or any other things that you want to discuss, if there's perhaps any questions that you have, any topics you want more information on, or just like to have a chat about the Ashburton funds or fixed income investments in general, please contact either myself or the BDMs, Ashburton BDMs, and we'll get back to you. And I hope you have a good couple of days for the rest of today and tomorrow. And then we are finally done with the 14th month of 2020. Have a good day, everyone. Goodbye.